with the conversation about what we saw happening in the stock market this week, sort of a summary of what's going on. And it was a really wild week altogether, as usual. This chart here shows the S&P 500 for the year so far. You can see that red line there is the trend line across the top. Obviously, the trend is down. The blue line is the 200-day moving average of these points. That's down too. We're below it. This week, actually, yesterday in the morning, we hit the lowest point for the year. And this week was a big deal because of the inflation report. And that's really what we were waiting for. Lots of other things happening, lots of reports. But this is the week of inflation. I guess you could probably call this the year of inflation. And so, when this report comes out, if the inflation is lower than expected, maybe the market rallies up and we get going again, because then the Federal Reserve can start to back off on these interest rate increases. If the inflation report is worse than expected, then there's the worry, okay, the Fed's going to have to raise rates even more as far as that goes. And so let's take a look at the report. So first of all, this is the overall, what they call the top line CPI, Consumer Price Index report. And you can see here, historically, we've seen some run-ups, but the peak that we hit was in July, right? 9.1%. So the number that came out this week was 8.2%. So that's good compared to 9.1. But unfortunately, expectation was 8.1, and we actually came out slightly higher than that. So that's kind of makes a problem for the market, at least in the short term. But the really big issue here is how slow it's coming down, right? And so it's not coming down fast enough. The Federal Reserve theoretically look at that and start to push on it and what have you. But to really understand inflation and understand how the Federal Reserve is going to react to things, you kind of have to take a look at some other pieces. One is what's called core inflation. So I'll show you that here. And so core inflation is where they take the overall top line inflation, they take out food and energy, and they look at everything else. And so you can see here, we've actually had 2 months in a row of increase, and we're up to 6.7% here, which is a 40-year high on core inflation. And unfortunately, we were coming down. If you look back, kind of peaked out in March there, we were coming down 5 months in a row. That was looking good. We were starting to go in the right direction. Even had a little rally this summer, I think, partly around that. And now we're going the opposite direction, and inflation's actually going up on the core inflation. This is what the stock market looks at and says, uh-oh, the Federal Reserve is going to end up raising rates even more than expected. And so now the overall market bets on what the Federal Reserve is going to do has moved up. And so we've seen a situation where, 3/4 point increase is expected November 2nd. That one's been out there for a while. But now the December meeting, which is in the middle of December, is now expected to go from maybe 0.5%. Now maybe that's 3/4. And then the end of the January meeting is now at 0.5%. So if you think about that, that's 2% more than we have right now. We're at that 3.25 range. So that brings us up to that 5.25 range. That's higher than the Federal Reserve projected at their last meeting, and that made the stock market go down. So what happened, though, if you look at what was going on, yesterday was really crazy. So all these bad numbers come out. The stock market is kind of falling down 2.5%, kind of what you'd expect, right? Okay, the market's going to have to readjust to the Federal Reserve being more aggressive, not less. There's no pivot in these numbers, right? And so all of a sudden the market turns around and it really ripped. I mean, when you look at it on a minute-by-minute basis, it was incredible how much it was going up. And we ended up 2.6%. So there's this 5% plus range from high to low in there. And, why? Why did that happen? Why did it go up? Well, when you look at what happens, we've had 6 of these big reversals in this year so far. The last time we had that many reversals was 2008. Okay, so why is that? It's because during these big downturns, the number of people out there and investors out there that are shorting the market, meaning they think it's going to go down. It could be an individual stock, the whole market, whatever it is, grows, right? Because everybody starts to see the same things and they all get on the same side of the table. And so when you short a position, you're basically borrowing that position from some institution and you're selling it in the market, hope it goes lower so you can buy it back. But when it starts to go higher, you kind of panic and you start to buy it back, which of course makes it go up even more. But seems like the catalyst for the bottom in this particular case was actually a big group of puts. And so you would buy a put option because you think the stock market's going to go down, and put options go up when the market goes down. And when it got to negative 2.5% in the morning, a lot of those put options were sold at a profit, right? And so there's market makers on the other side of those put options, and so they're unwinding their hedges, and by doing that, they're basically buying stock. And that was kind of the beginning. We also hit some technical levels that were really kind of interesting to watch. We hit the 50% retracement level. So what that means is if you go to the bottom in March to the top of 2020, to the top in January of this year, and you would look at that and say, okay, that's the total return that was made. It's now given back half of that. And so a lot of people pay attention to that, and there's probably a lot of buys right at that 50% place because it got right there and then whoop, took off to the upside. And so, you've got these different battles going on that are happening and what have you. And a little bit of upturn can turn into a big upturn in these type of markets because of the amount of short interest that's out there. Now, the problem is if you're hoping that the market's going to continue and, okay, it's over, we just had a great day, we're going to go. I mean, that's what happened in 2020. You would have a great day and then boom, 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 it would go, right? That's not happening here because the major trend is down. And unfortunately, the reason that we're getting this big run up is because of short covering, not because a bunch of people are running in and buying, on the long side. And so sometimes that can turn into a big run up. We saw that in the summer, right? Kind of that big run up from the middle of June to the very beginning of August, had like a 10% run. Most of that started, in my opinion, with short covering. And then it became a thing where everybody was trying to jump on board. That ended up failing right at the 200-day moving average. But these are failing a lot faster. I mean, the beginning of the month here, we had 5.7% jump in 2 days. That failed, right? Here today, we're taking back what happened yesterday as we speak. Almost all of it, and probably will by the time the show's over. The market will close, and we're giving that back. And that's because these movements that are happening on this positive direction at the moment are kind of false. They're not their true movement. It's not like everybody's running in and buying. It's that these people that have shorts are panicking. One thing when you short something can go up forever, right? And so you have an unlimited risk. And so that's what scares these guys out of these positions, and they take their profits. And these are, unfortunately right now, the people that are left in the market to a certain degree are a lot of traders. And so it's kind of a shorter term outlook. And so it drops 2.5% in a day like yesterday morning, they'll take it. They're not waiting for 5 weeks or something to see what's going to happen.
Yeah, especially since most of these people are leveraged in some form. They're going to do option trading rather than doing just kind of pure one-to-one trading that a normal person would do.
Yeah, and there was some, talk about whether or not maybe somebody had a big margin call yesterday. And, we don't find out the true results for some of these things until later as far as that goes. But one of the things that you can watch is you can look at the highest shorted stocks and how they did. So Bloomberg often reports that, and they'll say, okay, the stock market was down, up 3%, but the most shorted stocks were up 6.5%, right? Well, it tells you that short covering that's probably driving this thing as far as that goes. So overall, everything is still continuing as far as that goes. And the big difference this week is that it looks like the Federal Reserve is going to have to go to a higher peak inflation rate. They were expecting in the last meeting 4.6%, and now the market is basically betting on a 5 to 5.25%. And so that continues to move up, and the more rates go up, the more pressure it puts on the stock market and the bond market for that matter. And you end up with this kind of readjustment to the downside, and then you've got all these technical things. So what happens when we break through that 50% retracement? There isn't a lot of holdup in between that and kind of the next level of retracement, which is seen at 61.8%. You could drop another 200 or 300 points, maybe 10%, pretty quickly on the S&P 500. So that's why right now we have kind of that T-bill holdings, ultra short-term bonds. For the majority of our portfolio, we have this inverse positions, and we added one this week, which is doing well. I'm pretty happy with it, but we have a S&P 500 inverse. We have the Dow inverse. We haven't made money on that one yet. We got that at a lower price, but if the market keeps coming down, we will. And then we also bought an emerging markets inverse, And the reason we did the emerging markets, and again, this is not in all the portfolios, but just in general, one of the reasons that we are looking at the emerging markets inverse is just that the dollar is so strong. When the dollar goes up and up and up, it makes the value of emerging market stocks go down. So it's sort of a bet on the dollar as far as that goes. And it's a different market. So yesterday when, the inverses went down because the market was up so much, the emerging markets inverse was not down that much. So it's kind of nice to have some diversification in that regard. So altogether, we're prepared if things do get worse. It seems like they'll continue to be pushed to the downside, but anything can change at any time, and you got to be really careful to keep an open mind, and we certainly are. So that's what we see happening this week. Lots of little details in here, but I tried to hit the highlights as far as that goes.
Could you talk a little bit about the consumer sentiment that came out this morning?
Yeah. As a matter of fact, I've got another chart on that too. Let me show you, because this is actually somewhat important. So the consumer sentiment is a giant survey that comes out, and lots of pieces of it, but this is the part that probably has the most impact right now, because one of the questions they ask is, what is your expectations for inflation, right, in the future? And so one of the pieces is 1 year in the future. And so you can see here that all of a sudden in October we had a big jump in terms of the expectations for inflation. The Federal Reserve, Chairman Powell, has actually talked about this survey and this expectation as something that they're trying to affect. Because what they've seen is that when people expect inflation to be higher in the future, it can be kind of a self-fulfilling prophecy. It changes consumer behavior, and it makes inflation stickier, in their opinion. And so whether that's true or not, it doesn't matter, because their opinion matters in the end. And if they feel like they still have to be more aggressive, then of course that creates problems for the market. So it's a good question. It's really interesting what's happening there. That popped up, basically we've seen, higher prices. People have seen that core inflation that we're seeing, that's affecting real people. Gas prices have gotten maybe a little bit better, in this survey would probably reflect what really happened in September, but gas prices did start to come up really kind of middle of September. So we'll see how that, because that's can be one of the biggest impacts on this type of survey is what people are paying at the bump as far as that goes. But yeah, really fascinating time frame, of course. Lots of things that are kind of cross currents that are coming together here. And so that's why, there's not a lot of places to go in our opinions. And, again, at the end of August, we started moving out. September 22nd, we started to do the inverse. Most of that has worked out really well so far because the market has just continued to kind of erode. We still have our high capital gains and legacy positions that are out there in the market as far as that goes. But outside of that, we've moved everything else over to these other areas and just waiting and hoping for, some time that we can buy back in at a better point.